All right, so with the housekeeping out of the way, I am very excited to introduce Kyle Pacheco. Kyle is one of our partners in the Assurance Services Department. He serves as a consultant to his clients in the construction industry and helps with a wide variety of projects with scopes from implementation of new accounting standards to internal control design and effectiveness and an analysis of overhead and cost allocation to projects. He is a certified construction industry financial professional as well as a CPA. And Kyle very recently won the Texas Society of CPAs 2023 Rising Star Award. Kyle, thanks for joining us today and take it away.
Thank you, Lucas. Thank you also to everyone who joined us on this webinar today. We got an exciting topic geared up for y'all. It's ASU 2016-03, Financial Instruments, Credit Losses, Topic 326, or as most of us just commonly refer to it as CECL. There we go. Got it working now. Quick little disclaimer. There's some content on here from the FASB or an AICPA. The views expressed and guidance provided do not constitute client advice or create a client relationship. And then kind of before we dive too much into this standard, just wanted to give some quick background on it. So this standard really came out as a result of the 2008 financial crisis. FASB was concerned that the credit losses related to that were identified far too late for effective remediation. The standard primarily affects credit lending institutions like banks and lenders. However, the guidance is very broadly written, so that essentially all entities are subject to the requirements of CECL. The large impact that it's going to hit most of our clients and you all is going to be the impact to the trade receivables, your AR balances and stuff like that, that most companies do have. So at a high level, the guidance addresses these three key areas: the CECL impairment model for financial assets measured at amortized cost, available for sale debt security impairment model, and then the purchase credit deteriorated assets as well. So under the standard, entities must estimate the amount of expected credit lifetime losses on all financial assets. This does range from your short-term like trade AR, as well as any sort of long-term notes receivable that you have. The big kind of cumbersome part of this is going to be the gathering this information needed to require the modeling is a substantial undertaking. You got to enhance your policies, procedurals, internal controls as well, particularly around gathering the historical credit losses, your past write-offs, and also there's a lot of additional financial statement disclosures that are required, which we'll kind of dive into later in this presentation as well. And so as far as implementation of this standard, public entities, this was essentially required to be adopted in your reporting periods for calendars, year-end clients in 2020. Non-public entities, it was originally required to be reported starting in 2022 for calendar years and then delayed by 1 year. So most calendar year entities will be adopting this effective for the years ending 12/31/2023.
So Kyle, for our clients and our friends that are online, this could be affecting them right now. If you're going through an audit of your 2023 financial statements and you're a calendar year end, these are things that your auditors are going to be looking for, correct?
That is correct, yeah.
Okay.
So any calendar year end clients, as you're going through, your audit, your review, your compilation, anything like that, this will be impacted for this year.
So if you're on a fiscal year end, you get to buy yourself another year. It's not until 25?
As long as your fiscal year is after 12/15/2022.
Okay.
Yes.
All right.
Buy yourself a little extra time, but I wouldn't delay it just because you don't have to start right now. I would go ahead and start looking at kind of what the requirements are and make sure you have the information you need.
Got
and
it.
you don't
Okay.
have to modify any of your processes or controls or anything like that. All right. So we'll kind of start by looking at some of the key differences between the legacy GAAP model and CECL model. We have this nice little table here that kind of summarizes these. Um, Under legacy GAAP, you only recognize the loss as of the balance sheet date. Under the current model, ASC 326 or CECL, anytime you anticipate lifetime credit losses, you would have to record these, essentially at the start. So this really results in earlier recognition of the losses. And a lot of the guidance that you read through this, you shouldn't have zero allowance for credit losses. You might be able to make the argument that it's possibly immaterial, but a lot of the guidance recommends that you don't just say the expected credit losses is zero. On the unit of measurement, not a huge change here. Under legacy GAAP, you could pull if the kind of criteria were the same. However, under CECL, you are required to pull all assets when they share similar risk characteristics. On the economic circumstances, under legacy GAAP, you only had to consider current economic conditions. Under CECL, you have to look at current economic conditions, past historical results, and then you got to kind of almost essentially develop a crystal ball. You got to be able to figure out what's going to happen in the future as well. I guess FASB thinks we're all like can read crystal balls, figure out what's going to happen in the future, but another fun little caveat that they added into this one. Same kind of applies to the contractual term. Under legacy GAAP, it wasn't part of the original calculation, but under CECL, you kind of have to look at over the whole asset's life, kind of factor in those future events. There's a note here, like if you are a lessor of some sort of real estate, you should consider the possibility of term extensions on the lease term to develop that estimate for your future cash flows and any sort of impairment needed for the credit losses. So some of the key takeaways from this, as mentioned earlier, there is an earlier recognition of the losses since the credit losses are recognized at the creation of the financial asset and not just as of the balance sheet date. And then you kind of look at the historical losses based on past, present, as well as those future developments. And the other big kind of takeaway is there's additional assets to consider for the expected credit losses. Just because the standard's written so broadly, there's not just certain things that are applicable to it. It's pretty much any sort of financial asset that you have where you expect to receive cash flows in the future. So with that being said, kind of the next sort of topic in our presentation is, so what does CECL apply to and kind of what does it not apply to? So the model does apply to these following financial assets. If you have loans receivable, any sort of held to maturity debt securities like corporate bonds, mortgage-backed securities, municipal bonds, or any sort of other fixed income instruments, and the trade and reinsurance receivables, that's the big part that we see impacting most of our clients. So we'll kind of focus in a lot on that one as we go through this presentation and how it kind of impacts, what some of the common methods are to determine what your expected credit losses will be. If you do have any sort of net investments and leases for like the lesser type side entities, loan commitments, including like your lines of credit for like your financial institutions, and then any sort of financial guarantees accounted for under ASC 460 as well. And
Well,
kind of like I mentioned, go ahead.
Sorry, go ahead. I was just going to say, you mentioned that the standard is written really broadly. A lot of these are going to be things that are not necessarily applicable to every company. But the kicker is that third bullet point with trade receivables. So that's really anybody with regular trade AR, correct?
Correct. Yeah. So if you do have trade AR, you are subject to the CECL analysis. And for those of you looking for CPE credit, it does look like our first poll is up there. So, and also kind of as mentioned before, essentially any sort of financial asset that you have that's not excluded, which is on the next slide, and represents a contractual cash flow, it will be subject to the CECL reporting requirements. So with that being said, so here are some of the common types of assets that are excluded from a CECL model. So if you're an EBP plan, the loans made to participants for any sort of defined contribution EBP plan, those are excluded. Policy loan receivables of an insurance entity. Here's one of the big items, promises to give or pledges receivable for a not-for-profit entity. And then another big item I at least see a lot is that the loans or receivables between entities under common control. So related party receivables are also not subject to this standard too. And
Kyle, I just wanted to hop in real quick. I was looking at the list of attendees, and a lot of the folks that are on here tonight or today are actually not-for-profits. So looking at that third bullet, promises to give or pledges receivable are carved out. But for organizations that have revenue that's recognized under 606, so that could be something like programmatic revenue for admissions to a museum or memberships to an organization. For private schools, that could be tuition. This standard does apply to those. It's just the contributions receivable that are excluded, correct?
correct.
Yeah.
Yeah.
Okay. Perfect. Thanks.
So we also have another little table here with some common questions. So cash equivalents are within the scope of ASC 326. Loans and receivables to equity method investees are tax receivables from tax authorities are not covered under this. And then loans from officers, however, are, as well as potentially the forgivable employee loans, as long as they meet the definition of a financial asset. So some of the key concepts in applying the CECL model are essentially that your estimated credit losses, it's the difference between your expected cash flows you expect to receive and the asset's amortized cost. CECL does require the recognition of the credit loss before the loss is incurred or probable. You'll see kind of later on as we kind of get into it, you don't directly write off that asset or write it down. You essentially just establish kind of this reserve or kind of like a contra asset and kind of adjust that over time as certain additional information comes to light. And you know, the other kind of uncertain part of this is that it does require for you to estimate those credit losses, but they don't provide, you know, exactly specific guidance like use this model or here's how you do it. But there are some common methods that can be used, and we'll kind of dive into some of those a little later in the slides and kind of show you how those apply to, you know, like trade AR or available for sale debt securities and stuff like that. So as mentioned earlier, the credit losses are established through the allowance account. Write-downs of the asset are recorded against the allowance. Recoveries are recorded as a credit to the income statement, the period which that cash is later collected. So if you do end up, you know, reserving for something and, you know, by the luck of, you know, whoever it is, and you do end up collecting it, you do end up getting credit for it on your income statement in a future period. CECL does allow you to look at the value of collateral when determining the estimated credit losses to kind of limit that credit loss a little bit as well. There's a slightly simplified approach for the available for sale debt securities. A lot of the transition here is done as a modified retrospective approach as of the effective date. So you don't have to go back and restate prior periods for this. You just kind of record any sort of cumulative impact to retained earnings at the point of adoption. And I think we mentioned earlier that there are some more disclosure requirements. They are much more rigorous, and we'll hop in through some of the common ones, some less common ones, and time permit. There are a few public entity related disclosures as well that we can kind of hit on a little bit as long as time allows. So some of the foundational concepts of CECL, you kind of heard me say earlier that the credit loss is the difference between the cash flows and amortized costs of the asset. So what is amortized cost? So amortized cost is made up of your unpaid principal balance, any sort of accrued interest, premium or discount, write-offs you've recorded. If it has foreign exchange adjustments or fair value hedges, those would all be kind of netted against that principal balance to get to your amortized cost. And for most short-term receivables, your amortized cost will actually be your carrying amount. So that'd be like your trade AR, kind of whatever you have it on the books for would represent that amortized cost. So a lot of those other items there, like the interest, the premium discounts and stuff like that, wouldn't necessarily apply to those. So as mentioned earlier, there's not a certain method to utilize, but here are some of the common judgments that you should look at. What methods are you using to determine your historical experience? What data are you using? How are you using that to estimate this process? So as you're going through that too, how do you adjust your loss statistics for recoveries? Kind of past, how much recoveries do you actually have in the future period that you thought were uncollectible? As well as kind of developing an accounting policy for when you actually receive that payment for stuff that you've previously written off. If there are prepayments, that's kind of important on the discounted cash flow model that's utilized. Probably not necessarily so much on AR because, if it's not on the balance sheet because they've already prepaid, you don't really have to worry about it from that standpoint. Revisions to historical information when those estimates are no longer reasonable. We all unfortunately probably remember COVID was only just a few years ago, but if your historical losses, were pretty minimal, that brought on, some heightened bankruptcies and stuff like that. So, if your past reserve was only, maybe 1 or 2% of AR, you might have to look at, if we do have some sort of unfortunate future event like COVID, raising that loss a little bit just due to the uncertainties and potential for additional companies going bankrupt and not being able to pay for those AR that they have outstanding. And then if you are going to look at pulling, just defining out what the similarity of those risk characteristics are, and just trying to constantly reevaluate those to see if those are still correct and don't need any sort of adjustments in the future. So now we'll dive into a couple of the common models that you can utilize to estimate your credit losses. So those are options, the discounted cash flow models, that's still an option, as mentioned earlier, for the available for sale debt securities. That's particularly useful if you have, long-term notes receivable, loans receivable, stuff like that. That's probably a decent option there as well. The loss rate method, roll rate method, and kind of the aging schedule analysis. So those middle two there, and then that bottom one, those would be some of the common ones that I typically see applied to like your trade AR, which will likely impact people. And then also there's the probability of default method. So here's some of the common approaches again. So the aging schedule, this model is based on the number of days receivables have been outstanding. We do have a pretty good example of this a little later, but essentially, the the longer past due a receivable is, the more or less likely you'll be able to collect on it. So you'll see kind of like a additional kind of reserve amount being applied for those items that are aged, over 90 days, over 180 days, stuff like that. The loss rate method, you essentially calculate an estimated loss rate and apply that to the asset's amortized cost as of the balance sheet date. That's going to be, definitely utilizing a lot of historical information and also looking at, current economic conditions and get your crystal ball back out again and kind of like try to estimate what's going to happen in the future. The roll rate method and loss rate method are very similar in approach. So that essentially that's the same kind of factors that utilize and to go into that calculation. The discounted cash flow method, that's looking at your amortized costs versus the present cash flows. So you discount that receivable or that sort of financial asset back using present cash flows, and the difference between what you're carrying it for now and that's determines your credit loss. So let's dive into a couple of these common methods. So the first one up here is the aging approach example. So this is a manufacturer. They sell a broad range of customers, primarily retail toy stores. Sorry, got a little tongue tied there. Customers are typically provided payment terms of 260 net 90. So they've kind of tracked their historical loss experience over the past 5 years. And you'll kind of see this is their aging approach and those reserve amounts that they've applied, and kind of the past write downs. So you'll see, receivables that are current, those are almost pretty much fully collectible, only a 0.03% reserve, 8% for those that are 1 to 30 days past due, 26% for 31 to 60, about 60% for 61 to 90. And then, as you would expect, receivables that are aged past 90 days have a pretty good reserve amount of about 82%. And then kind of diving into, they feel like their historical loss is consistent to be experienced kind of for future as well, and current conditions. So no big major changes there. This next slide here, we kind of have their aging schedule as well as those loss rates that we showed. And, you kind of do the multiplication there, taking the carrying value for each of those major aging categories against the loss rate for that, and you get that expected credit loss estimate. So in this example of, roughly $6 million in trade AR, its expected credit loss estimate is, just shy of 21,000 there. As mentioned, this is a pretty good example for items like trade AR. And also, as you'll see here, as the items do get older, that loss rate does increase, pretty from almost nothing for the current to, 82% of those items aged over 90 days, which I think most of us on this call would generally agree with that. As stuff does get older, its collection is a little less likely. And that's typically when you see a lot more write-offs. And hopefully your aging buckets look about like this, where, a good chunk of it is in current, then you got some smaller amounts in those older categories to just, keeping that cash flow pumping through at a pretty good rate. The next one up, the loss rate and roll rates. As mentioned earlier, these the calculations here and the approaches are pretty similar. On the loss rate, you'll multiply the amortized cost of the asset by your estimated annual loss rate. And then on the roll rate, you do the same, but the rate applied reflects historical trends and credit quality indicators across the duration of the borrowing. So here's a kind of a detailed example of this one here on the loss rate. Essentially here they have, $14 million in receivables, average balance over the reporting period. Their historical loss rate is about 1.43%. And that would kind of be the average of those values you see across the bottom there. Year one being 1.45, year two, 1.43, year three, 1.42, year four, 1.41. And then due to, looking at some future information, current economic circumstances, they determined that kind of their reasonable and supportable forecast in this example is 1.45%. So it's slightly higher than that historical loss rate that you see of 1.43. Sorry, excuse me. So using this loss rate approach, your estimated credit loss would be approximately $203,000, which would be your $14,000 in average receivable balance from up above times the estimated loss rate of 1.45%. This is another good example that I see applied to like trade AR, or if you have contract assets on your balance sheet that are generated when you apply the ASC 606 for revenue recognition from contracts with customers as well. The discounted cash flow approach is the next one up that we'll kind of dive into a little bit. This method may best be utilized on held to maturity debt securities. Essentially take the expected cash flows and contractual cash flows and discount those using the effective interest rate. And then the difference between those two are your estimated credit loss. So in this example here, this entity invests $10,000 in a debt security with a face amount of $10,000, a coupon interest rate of 4.5%, and a term of 5 years. It's been classified as a held to maturity investment. And the expected credit losses at acquisition date was immaterial. During 2019, the issuer experienced financial difficulty. And the holder of this investment estimated the fair value of their investment to be $8,800 at the reporting period. And they prepared the following cash flow analysis to show the amount it expects to collect from the security.
Kyle, there's I think a relevant question in the chat here. Is there any specific guidance on what interest rate to use when you're using the discounted cash flows? I mean, in the example here, it gives us the interest rate of 4.5%, but would it be fair, do you think, if there's not specific guidance, to use the risk-free credit, the risk-free rate from the Treasury, and then layer on some of these additional environmental factors that you talked about in a couple of slides earlier?
Yeah, I think so. If there's not a stated rate in it, a lot of the times with the discounted cash flow example, it's going to be for some sort of investment that has a stated rate,
Okay.
or it's going to be like a loan receivable where you have that stated interest rate in it, or something along those lines. But I think you could, probably justifiably kind of estimate a rate if you wanted to utilize this approach as well. And the risk-free rate that you mentioned earlier is probably a good starting point, and then factoring in any sort of additional considerations, like if there is collateral, maybe that reduces the rate, or if there's not collateralized or something like that, it might increase the rate as
Okay.
well.
Okay. So it's important to not only consider I guess traditionally we have relied on historical data, things like the aging bucket methodology that you showed, relied on historical data pretty much solely to help us determine what that used to be called as the allowance for doubtful accounts. But now we need to make sure that we also take into consideration, there were some really great bullet points back on slide 21 about the environmental factors that we need to consider. Not how, are you in the middle of a pandemic? How is that going to affect, your client's abilities to pay? and maybe their own financial health, things that tend to be outside of just the historical data approach.
Right. Definitely. So kind of continuing on with this example here, here's the discounted cash flow model. So, the original expected cash flows were $10,000. They discounted those back. Cash flows expected is $8,880. So the allowance for credit losses on this model is about a 1,120 on this $10,000 investment. Sorry, excuse me 1 second. Right, so kind of next up here is some presentation and disclosure requirements. So on the balance sheet, financial assets measured at amortized cost are presented on the balance sheet at amortized cost. Available for sale debt securities are presented at fair value with the amortized cost presented in parentheses. And then any sort of off-balance sheet credit exposure is not disclosed on your balance sheet. It's just disclosed in the footnotes only. The allowance for credit losses on financial assets are presented separately as kind of like a contra asset deducted from the asset's amortized cost. For those amortized cost financial assets, the available for sale debt securities are presented in parenthetically on the allowance for credit loss, and then off-balance sheet credit exposure is presented as a liability. On the income statement, financial assets measured at amortized cost, those are represented as a credit loss expense. Actually, for all three, for assets measured at amortized cost, available for sale debt securities, and any sort of off-balance sheet credit exposure, all shows as the income statement as credit loss expense. And the overall kind of objective for the disclosure requirements for CECL is really to enable the financial statement users to understand the following: the credit risk in your portfolio, how management monitors that credit risk in the portfolio, what your expected credit losses estimate is, as well as any sort of changes in the estimated credit loss that have taken during the current period. There's a lot of detailed disclosures about the following items. So credit quality information, we're going to dive into each of these a little bit, and what needs to be reported as well. So the credit quality information, allowance for expected credit losses, your past due status, any sort of assets you hold that are non-accrual status, any sort of off-balance sheet credit exposures as well, any collateral dependent financial assets, or then any of the purchased credit assets with credit deterioration, or PCD assets, as they're commonly referred to. So on the credit quality information, the objective of this disclosure should enable the financial statement users to understand how management monitors the credit quality of its debt instruments and how management assesses the quantitative and qualitative risks arising from the credit quality of its debt instruments. Sorry, excuse me. One important note here is that this disclosure does not apply to short-term receivables that result from your revenue transactions within the scope of ASC 606 revenue from contracts with customers. So this would be like your trade receivables or your contract assets. You don't have to disclose the credit quality information around those. And then obviously, since we're talking about the expected credit losses, you have to disclose what your allowance for expected credit losses is. Those disclosures here would include management's method for developing its allowance for expected credit losses, the information management used in developing that, including any sort of current estimates, and then the economic circumstances that cause changes to this allowance, either upwards or downwards or a reversal that were recognized during the period.
Kyle, on the allowance for expected credit losses, a lot of clients have said in the past that they really haven't experienced a whole lot of allowance for doubtful accounts, or they haven't had any troubles with collections. Under this new CECL model, do you foresee a situation where it could be that the answer is zero? We really don't have any expected credit losses, or must there be some sort of allowance that's created?
That's a great question, actually, Lucas. Everything you read about this, it does definitely state that the allowance should not be zero.
Yeah.
So maybe you can make that justification that it's zero, or maybe not considered material, and therefore you just disclose that your allowance for expected credit losses was not material, versus saying it was zero. Maybe the better method there is to say it was not material.
So, with your auditor hat on, are you still anticipating that our clients will need to work through this process at least once to demonstrate that it isn't material? Or should those conversations be happening with everybody and their particular auditor?
Yeah, I would definitely recommend, hopping on a call, going to a meeting, and just kind of walk through your facts and circumstances in your particular case. If you've, in the past, not had much in terms of bad debt expense, you probably have a reasonable justification for calling it not material. But I think I would also kind of look at that crystal ball effect,
Yeah.
needless to say, and maybe one of the things that, it's not necessarily per the guidance, but look at, what your collection rate is subsequent to year end on those receivables that you had on the books as of year end. If they're all collected, that's probably, another feather in your hat to justify that the reserve is not material.
Okay, thank you.
So on the allowance for credit losses, it does say, it should be done for each major portfolio segment. So you could have, an expected credit losses for like all of your trade AR, and expected credit losses for your contract asset as well. And, have the description about how each of those estimates are developed, any sort of risk characteristics on the pooling approach for each portfolio. Then one kind of major disclosure that I've seen, and this has been kind of one of the big changes that I've seen as I've started preparing financial statements with this model, is this roll forward of your allowance account. In the past, you just kind of had to state, here's what our allowance for doubtful accounts is for each period, but this is kind of a new required disclosure. And so you want to, the big takeaway here is kind of look at what type of reports or data you can pull out of your system, see if there's anything kind of a little more sophisticated than just kind of like a GL data dump that you kind of have to pull in and kind of summarize the values. But on this roll forward, you have to essentially take your beginning balance for the allowance for credit losses at the start of the balance sheet date. Your current period provision, any additions to your credit losses, any sort of initial allowance recognized against your PCD assets, any sort of write-offs you've charged against the allowance, any sort of recoveries for balances previously written off as well. And that should kind of help you arrive at your end of the day allowance for credit losses as well. If you do have, material past due financial assets, you should also provide an agent analysis of the amortized cost for those debt instruments that are past due as of the reporting date. This would, kind of show those financial statement users to help them understand the credit risk and then the interest income generated on those financial assets, kind of on that non-accrual status as well. You would need to disclose the amortized cost of those debt instruments, the amount of interest income recognized on those during the period since they've been put on non-accrual status, the amount of debt instruments that are 90 days or more past due, but not on the non-accrual status as of the reporting period, and then the total amortized cost of those debt instruments on non-accrual status. And then if you do have collateral dependent financial assets, you have to disclose kind of the nature of those, the type of collateral that you have by each class of financial asset, the major security type, and the qualitative disclosures of this should be done by each class of financial asset, major security type, any sort of significant changes to the extent in which the collateral secures those financial assets, and whether any changes or in that is due to general deterioration or some other reason as well. And there are a couple less common disclosure requirements. So there are some disclosures related to if you do have the PCD assets, you do have to disclose your purchase price of those, any discount attributable to the expected credit losses based on the acquirer's assessment, your discount or premium attributable to other factors, and then the par value of those PCD assets as well. There's also some disclosures related to any sort of off-balance sheet credit exposures that you have. These disclosures should include a description of the accounting policies and methodology utilized in making that estimate for your liability for off-balance sheet credit exposure, as well as any sort of related changes to those credit exposures. And this disclosure should also identify any factors that influence management's judgment and a discussion of the risk elements relevant for each category of those financial instruments as well. And we also do, like I mentioned earlier, there are a few additional disclosure requirements for the public entities. A lot of these do deal if you do have any sort of financing receivables or net investments of leases. Won't dive too much into these or go too in detail, as I don't know how much it'll impact most of the people here on the call. Just kind of wanted to throw that out there, that there are additional requirements if you are a public business entity.
Kyle, if you don't mind, before you jump into the public business entity stuff, there was one additional question that I think would probably be helpful. So there's a lot here in terms of what is required to be gathered for disclosures. Things that we, like as auditors, have never had to gather in the past. What do you think is the best way to kind of gather all this information up? Is it maybe working with management, or maybe crafting some memos that might have a lot of this information as management makes their assessment, and then we can lift that into the financials? What would you think would be the best approach?
Yeah, definitely. I think you're right on the spot there. It's going to be discussions with management, kind of walking through, your policies and procedures that you have. How do you evaluate the collectability of your receivables? What does that process look like? If you do have amounts that are past due, like how do you send those notifications? When do you start sending those notifications? Do utilize some sort of third-party debt collection service or something like that?
Mhm.
Kind of what's been the results of, all those different methods as well. But I think, you can kind of start this process off at first with just kind of walk me through like how you evaluate your trade receivables, for example, for collectability, and kind of what information do you have to show that kind of review?
Okay. So folks on the call need to be getting in front of their specific auditors and having these conversations early, so it's not a snag during field work.
Correct, yeah. Or, and it's not a snag on the 11th hour when you're trying to meet a deadline and you realize there's a lot of additional disclosures that need to go to the financials and a
Yeah.
lot more additional requests come up or questions that arise.
Okay. Perfect. Thank you.
Um, so, as kind of mentioned a little while ago, if you are a public business entity with investments and leases or any sort of other financial receivables, um, there are some additional disclosures related to credit quality indicators. Um, the real kind of purpose of this is to show credit trends by year of origin, um, particularly for those longer life receivables and assets. There's some additional disclosures as a result of ASU 2022-02 that focus on modifications of the receivable made to borrowers faced in financial difficulties. These disclosures allow the users to understand the kind of modifications that have been made, how big those modifications are, and how successful you have been in minimizing the potential credit losses from those borrowers under financial difficulties. Also, kind of along that same line of thought is if you do have debts due from people facing financial difficulty and results in a new loan or a modified loan, um, there's disclosures required about the amount of any commitments to lend extra funds to borrowers in financial distress. Um, if you've made any sort of modification of the receivables due to either principal forgiveness and interest rate reduction, payment delays or term extensions, um, and then disclosure of any sort of financing receivables that are also not subject to those. So if you have maybe like trade AR from that customer as well as like a long-term note, maybe some of those disclosures would not be applicable to the trade AR due from them, only with kind of the long-term notes receivable or kind of like your line of credit or something like that. And kind of the last couple pieces really are still kind of dealing with those borrowers facing financial difficulty and any sort of kind of principal forgiveness, interest rate reduction, and stuff along those lines as well. Um, and the last kind of piece there is disclosure requirements for any sort of gross write-offs by year of origination as well. And that essentially kind of concludes those disclosure requirements, and just like to kind of open it up again for questions if anyone has any.
I've been trying to answer them while we're going through. You're going to be getting a couple direct emails from some specific types of questions that are more appropriate for a one-off. Kyle, we were talking before we all hopped on. What After doing the presentation and walking through it in detail, what do you really think are some of the key, maybe 2 or 3 takeaways that we should leave with today?
I think the key takeaways are what assets these do apply to. More importantly, maybe what assets do you not have to worry about for these, as well as kind of what type of method you want to apply towards doing those. As mentioned earlier, like the trade AR examples before, where you're looking at either the agent analysis or the loss rate, the roll rate. I believe that's, some good information there. And then, I think the other key takeaway too is, how do you determine your starting point, which is your amortized cost for those assets reported on your balance sheet. Since you essentially use that as your starting point, and then look at expected cash flows in the future. I think if you don't have a good starting point, how do you know your ending point's good?
Right. Okay. Perfect. All right. Hang on one second. There's one more in the chat. Okay. Any other? This one, another great question. I know that you've done pretty extensive research on this topic specifically. What are some great sources if somebody wants to do a little bit more of a deeper dive?
Um, I think the FASB website as well has some good examples, particularly like as you get into like the implementation guidance
Mhm.
and like the particular like examples where it walks you through like how to determine your expected credit losses utilizing those different approaches. Those are
Okay.
probably the areas where I've found probably the most helpful. Um, also just doing kind of like a Google search. A lot of the big four accounting firms have some pretty good, almost kind of plain English accounting type guides that are a little easier to read as well.
And as always, if we can do anything to help you, don't hesitate to reach out. Thanks very much. And Kyle, thank you again for your time today.
Thank you, everyone. Thanks for joining us.